Audio update on the jobs report. I'm Rich Paz for Critical Point. It's 9:46 a.m. Eastern Time, April 5th. All right, the cash S&P 500 opened up slightly from yesterday's close. Got a tiny little gap. That could be a warning. There may be some selling later today. But right at the moment, the market's acting kind of firm, a little bit buoyant. And the model is saying if you want to take on the most amount of risk trying to call a bottom, meaning pure time dangle yourself over a frying pan, it's probably bottoming for not only level 4 but level 3. It may even bottom something far more important than that. And so we have to give it a chance. It's going to be bullish by next week. And I still say it's going into May. And there's now alternate scenarios saying it's probably just going right on up into June. And then we already know there's a variety of fluctuations when this market could stay up all the way to the end of the year. And we're also targeting July and September. We'll worry about all that stuff later. Right today, what's going on with this market? Well, we got a jobs report of 303,000 jobs, okay? It just blew right past all the polling and estimates. Why isn't the market crashing? Well, you could argue it kind of did the crashing yesterday. Maybe somebody knew it and was coming, but I don't think so. And I'll read some comments from John authors here in a moment, or at least some bullets. But there's, at any rate, on a long-term basis, this jobs report is fantastic. The model's happy-dappy. We've got higher stock prices coming this year. We've got higher stock prices coming this decade. Economy's going to continue to grow. It's great. It's fantastic. However, internally, we may have to do some other types of discussions. I'm seeing some studies showing that part-time jobs have been increasing for years and full-time jobs declining, but things are picking up as well. This jobs report might not be as hot as everyone thinks because people are still being forced to take part-time jobs. Someday we're going to fix that, okay? Maybe not today, but it's something to think about, but it's not enough to cause any kind of a problem right now. 303,000 jobs is flat out bullish. I don't care what kind of a job it is, okay? Now, of course, this could cause short-term negative behavior for some traders and investors, because they'll also look at it as a negative at the same time that it's a positive, in that it means interest rates are going to stay high. Some will even wonder, could we possibly even raise interest rates later in the year? What's going on with inflation? But to me, that's very short-term thinking, and you've already beat the market up enough here to consider maybe some of this is dialed in, even if they weren't actually trading in line with that. It's like, how come they already didn't hammer this? They went to buying immediately. So some of those statistics people are pointing to, that if the market's weak into a jobs report, it's normally up. It looks like it's working for the moment, but we don't know for sure. So what about that level 3 bottom do now? Well, the problem is, I thought today would be the latest allowed. The model's showing it might even be Tuesday, okay? Hopefully no later than Monday. So there can still be some slippage and things going wrong, but right at the moment, the market's it feels like it's rather comfortable here of saying, hey, people were complaining, how can you rally the market for 6 months and not even have a 2% setback? That's not normal. Well, now we've had a 2.5% setback, so they're saying, okay, we finally got one of those kind of setbacks, and in general, in a bull market, it's probably a buy, okay? So that's where we're at with that, and I have the cash market here as I'm making this up 26 points. I think it looks good. I think they beat things up a little bit too much. And now what I want to do is go over to the Points of Return newsletter, daily newsletter by John Authors over at Bloomberg. And you can sign up for it. Just search on Bloomberg. It's emailed to you for free. He's done some very good research here in the last 2 years, and I've liked John's stuff for, it seems like, many years, decades. I think he was was with Financial Times. But at any rate, what he pointed out was, for today's points, U.S. stocks worst retreat in 6 months, but still only 2% down. Now, he was talking about yesterday's behavior. Bibi Netanyahu over in Israel, not the Fed's cash carry, provided the excuse. He means the excuse to knock the market down. He was saying even though cash carry over the Fed Reserve said we may not lower interest rates at all this year, okay? Well, people didn't like to hear that, but what John's pointing out is that it's a good chance people were more worried of what's going on with Israel, the oil countries, Russia and oil production, and crude oil surged this week right along with the surge in interest rates. So it caused some people to take some profit, adjust their portfolios here a little bit. It caused some selling, all right? Now, to me, I do think Wall Street views that the biggest risk is geopolitical. There's really no risk of a recession, economic problems, no risk of debt and money printing, blowing things up in this country. We're rock solid. We're going to go ahead. We're going to have a great economy this year and maybe the next couple of years and stuff like that. So they're trying to figure out, well, what is going to shock the market someday and knock it down? And they decided they better go geopolitical because the world is wild and crazy, perhaps more so than U.S. Americans, that kind of thing. So we do have to consider they're going to play those games at times. So frankly, I think we've just seen a rise in the special event trader, who I think is normally very short term, normally on the bearish and worried side and pessimistic side. And they also impact the market almost daily. They're looking for some disaster every day. It's ridiculous. They become far more obsessed with this than, say, 20, 50 to 100 years ago. And they can trade so much faster and pump so much money into it. They are a bit of a nuisance and create some noise and fluctuations in these markets. I think they were there. But I think we settle on this jobs report, calm down. I think next week they're going to find out the world isn't falling apart and those special event traders go away. And they also have to cover their positions, so they may even be buying a little bit. And then we'll get back to the routine trader, who's really the bulk of the marketplace. Every day throughout the year, throughout years and years, okay, they connect the dots of all this news. They make these price charts happen. And I'm not talking about technical or chart people, but they just make these trends and fluctuations. They're the more important group, in my opinion, even though special events can be quite important at times. So we'll get back to the routine trader. We're going to calm down. And I think we've just seen a normal little tiny correction here in the market, and things will work around. Now, other things that John wanted to point out, the U.S. jobs market would be much hotter without big immigration. I haven't read that yet, but I'm going to. If you're worried by protectionism, sell China and buy India and Mexico. And then he puts that in there. Many have done that already. And yes, that's working for them. And then he has a nice little article on the Call of the Sea of how he was a singer and some songs and this and that. Something else to think about. Nice little newsletter today, and he's been on top of things. So I think we have seen a return to some of the normal behavior. The justice market can go down at times, but yes, it's still in larger long-term uptrends. We're still in a bull market. And this jobs report, the unemployment slipped from 3.9 to 3.8. On my charting, it just looks like normal behavior, nothing exciting, nothing to get carried away about. I think business cycle-wise, unemployment will trade in a range and occasionally scare ourselves because it came down much faster than normal because it also jumped so fast and over the COVID. And so I think it's just going to bounce around in a range. Jobs growth can cool off a bit and still have a strong economy, so I'm not concerned of something overreacting there. And so the jobs number, however, was a hot number. And so it's long-term bullish. The market's happy. I'm happy. Now we just have to deal with some of these short-term people that might cause a bit of problems for us bulls. At any rate, this market's going higher into May, maybe even higher into June before we get a chance for another sizable setback, something more than 2%. And then I think we'll only see it higher still later in the year as well. Upside targets remain intact. And now we just have to see, can we find a floor price now in the next few days to send this up? Because frankly, I think this market should recover into next week. And now I have the S&P 500 up 33. The interest rates did spike on this news, but it could have spiked a lot more. It's almost as if maybe they did make a bet of a hot jobs report, but I think it's some of this geopolitical stuff, a lot of other things. And they should have been more bullish than this on interest rates off of this jobs report. So I think they're pretty much done. If it hasn't topped on interest rates on a short-term to intermediate basis, I think it's going to do it by next week. I think it's going to back off a little bit in April, May here. And I think the stock market is still going to stay focused on the idea. Don't worry so much about the Fed Reserve, inflation. We'll deal with that later. Don't worry so much about interest rates and that sort of stuff. And they're also going to calm down on this geopolitical stuff. And the oil market's probably going to back off over the next month or so here. And it's approaching some of my targets now. And gold has been rocketing higher because of central banks, but also of concerns of what can go wrong. Everything's looking so good that something must break at some point. So they buy gold as just a little extra protection to go along with their profits. They were buying Bitcoin. Now they've kind of backed off of that a little bit. Dollar doesn't seem to know what to do. If there was a problem over this jobs report, if there was a serious problem over this geopolitical stuff and all this other news we got this week, why is the dollar not going crazy? It's not. So it's really the stock market, the only thing, and our interest rates got a little crazy this week. I think it's all going to settle down. We're all set here. I think we're probably going to see the stock S&P 500 bounce off its 5-week average. And a lot of people are going to say, damn it, should have bought that dip. You know, you always buy these really fast drops. They always overdo it. They always got it wrong. Well, I should be careful using the always, but that's an attitude of some of these traders. I think it's up and away, but we have some work to do after this hit that the market took here this week. Past results are not necessarily indicative of future results. Have a great day. Thank you.